Joining us now is Jeff Kilburg, founder of KKM Financial and a CNBC contributor. So don't be afraid, Jeff. Just jump into the market. Never worry about it. Don't look back.
Well, not necessarily, Kelly. If you remember, during the depths of the decline in April, I was out here talking about buying with both fists when a lot of people were on here repricing their S&P 500 targets. And you also saw a lot of folks talking about recession. But I think there's a way to thread the needle for all the FOMO folks out there and the fogies. That's a new one, Kelly. I like that. But there's a way to thread the needle, and I think that's using options, defining your risk, because I do believe with the way the Mag 7 has recovered here. Think about the Mag 7. What we saw in the month of May, they were up 13.4%. That was more than double what the S&P 500 was up in the month of May. And to quote my buddy Ryan Dietrich real quickly, when we see a month of May above 5% in gains, that 1 year later, on average, we see the market up 20%. And never have we seen a year of 20% declines. So all the people looking out there for that retest of 4,800 in the S&P 500, it's never happened before, and I don't think it's happening.
Well, so that's the conundrum is you go, okay, well, I guess April was an entry point for a couple of days, and now I get in and we're basically, back up at the highs. And do I just kind of trust it for the, those with a long enough time horizon don't have to worry too much about it. I guess it'd be those if they thought, okay, I'm approaching retirement, or this is for a 529 account, or, do I need something in here so that if there's a wobbly patch in the next 12, 24 months, it doesn't screw up my plans?
Well, it's not going to be a straight path. To your point, we're still figuring out about what the budget, the spending bill is. We just saw that come out from Elon Musk. And we're also still trying to land some trade tariff deals. So I agree with you. Volatility will stay elevated. But I think if you utilize options, and remember, SPY, S-P-Y, that's the ETF that we like to utilize for the S&P 500. Just back in early April, it was trading 481. Right now, it's above 595. So that is neck snapping V-shaped recovery. But I think I want to use an old strategy called a risk reversal, Kelly. That's going to have me selling a put. So I want to sell July 18th expiration. I want to sell that 580 put. It's going to allow me to collect, and I did this trade this morning, so I own it. I got skin in the game. I sold it at $8.65. I used most of that premium, all that premium, to buy the 595 call at the exact same expiration. It cost me $12.60. So it was about $395 I had to lay out per one lot spread for this risk reversal. But you see my break evens at 599. And if we go back up to that all-time high, which is about 6150 in the S&P 500 or $613 in the SPY, I have unlimited upside to this because my break even is 599. So all the FOMO folks and all the fogey folks, I'm using options to define my risk and better understand where I want to potentially come in.
Listen, some of us old fogies just want to just buy it, the stocks, and just hope they go up in the long run. I just want to mention we're 3% away from the all-time highs, Jeff. And according to Dietrich, when the S&P gains more than 5% in May, the next 12 months have never been lower and have gained nearly 20% on average. So time to leverage up.
Well, I don't know about that. I don't know about leveraging. I think it's time to continue the momentum, because what do we see in all this momentum? And I was very skeptical, Kelly, of the Mag 7, if you go back to Q1 this year, of being over-concentrated. So I think at the end of the day, momentum moves markets too far. But the S&P 500, it's not overbought on a relative strength index yet. So I think you have more room to run.